for that. And joining me now in the studio is Ananth Narayan, who is the former whole-time director at SEBI. Ananth, we have two issues to discuss. One is the SEBI retail survey which has come in, and the second one is the big one, the CAS, which is there. So let's start off with the retail survey. Do you think things have improved in the last 1 year? There have been a lot of actions which have been taken by SEBI, consolidation of lots, this, STT coming in so that the transaction cost goes up. But we still see the retail losses at over 1 lakh.
I think there are some positives, Sajid, but clearly lots of things to worry about. The fact that the number of small traders has come down is a good sign that people who are discerning are coming into the market. But the fact remains that if we still have 35% of people with zero holdings trading in options, 70% of those holding below 1 lakh rupees actually losing money in options, it does look like that the small traders are still at the receiving end of the stick and at the mercy, so to speak, of the larger institutional, smarter, algo-driven players. So that is still a worrisome area. I think there were 3 worries that SEBI had expressed when we first started taking action way back in 2024. The first was clearly this thing about investor protection. After all, that's the first mandate for SEBI. Yeah. And the fact that small traders are losing out consistently is a problem. And there seems to be a level of addiction also. The SEBI report shows that as well. The second issue, Sajid, was that if you look at the size of the derivative market, particularly the index options market on expiry day, in equivalent cash terms, the volumes are tremendously more than the underlying cash market. It's sometimes 700, 800, 900 times the underlying cash market on expiry day. Yeah. Which means the setting which happens in the cash market is based on thin volumes, which is impacting the settlement which happens for far larger volumes on the options market.
That's right.
That's something which worries the regulator at all times, because it almost reminds you of the LIBOR situation, where a tiny market can influence a much bigger market. The final part is, again, which comes out in the report, a lot of the contracts and the volumes are in the immediate, on the expiry day, or at best up to the next week, right? Now, healthy derivative ecosystems have more than 60-70% of the contracts beyond one month.
True.
Here, practically everything expires within the next 1 week. And there are academic research papers which suggest that the last day is a 0 day to expiry kind of trading actually increases market volatility, doesn't decrease it, right? So the health of the derivative ecosystem, frankly, can do with a lot more of longer tenor derivative contracts rather than shorter tenor. These are 3 worries. On the other side, Sajid, I think SEBI is also very conscious. A lot of intermediaries and market participants depend on derivatives for revenues. True. Exchanges, clearing corporations, brokers, a lot of their revenues come from derivatives, especially from index options.
And weekly options.
And especially weekly options on expiry day. So you've got to make sure that whatever steps you takes all this into account and does not end up with unintended consequences that disturb the entire capital formation ecosystem. So it's a tough job for SEBI, but I think it's going on the right path, being very, very thoughtful, being very, very calibrated in its responses after a lot of consultation, and then taking stock as it did yesterday by coming out with this report, which will again hopefully spark some more debate on what needs to be done to strengthen the ecosystem going forward. And I'm sure steps will go towards us going to a more stable and acceptable kind of a ecosystem.
It's something like the system is now used to having that kind of liquidity, weekly one, which comes in. But SEBI having opened the doors to weekly options, is it going to be easy for them to close? Because SEBI is pushing for longer tenure contracts.
I don't think it's a question of necessarily only closing weekly options. I think there are multiple things required here. One is, of course, I think there is a debate required on who we allowed to participate in weekly options or in eligibility. So suitability appropriateness of some kind. I know it's a big word and people get scared about it, but...
And you've been talking about it for like 3-4 years. The SEBI has been talking about it. Nothing has come out of it.
As I said, I think SEBI's approach has been extremely calibrated. We don't want to do... I'm no longer with SEBI. I can't speak for SEBI. But at least when I was there, the idea was, let's not be precipitative. Things are going along. It's not as if the system is under complete strain as of now. So we have to be very calibrated about how we go about doing things, making sure that we don't end up disturbing the ecosystem one way or the other. But I think the continued reports, including yesterday's report, shows that small traders are continuing to lose out. They seem to be at a distinct disadvantage compared to the larger algo players. And therefore, this question about investor protection and suitability appropriateness has to be debated. And what is the best way of achieving that, I think, has to be debated.
While this report talks about how active traders have fallen by 20%, in the last 1 year, the returns haven't been so much from the market. So the number of demat hold additions have also been slowing. And so, you have to take that fall in active traders of 20% in context to the number of demat holders or new investors who are coming in as well. So equity as a whole, which was attracting a lot of investors, have also come down, have cooled off for last 1.5 years because of the returns. So should you put so much of focus on saying that, active investors have fallen 20%, but overall,
I think it's a very fair point, and you're right. This is not one variable which is determining everything. There are multiple things happening at the same time. At the same time, I think it is statistically significant that the number of participants have come down. I think what is specifically significant is a lot of people exited during FY26, and a large number, I think 40 odd lakh people exited, which is again a sign. Having said that, I think the questions still remain. The point about investor protection, the point about increasing cash market volumes. Even if you don't decrease, derivative market volumes, I think it's important that the cash market volumes go up. That's important. Third is, and I think SEBI is working on this, how do we increase the number of contracts beyond the longer tenor, more beyond 1 year? Because that's where the real hedging from people like, sovereign wealth funds or institutional investors can really happen, and that's the market that we want. So I think it's a work in progress, and I think SEBI is doing this the right way in a very calibrated, thoughtful fashion without disturbing the ecosystem as a whole.
You spoke about the suitability factor here, and, and a lot of things have been written about it and spoken about it with SEBI. Whenever the interactions are happening, whether it should be on the net worth criteria, whether it should be on whether they are trained investors, are they appropriate investors in terms of knowledge of trading in F&O. Are these some of the things that should now come into play for any new one investor coming in? Because I've seen kids attaining the age of 18 and now getting into F&O trade because the premium is too small for them to invest.
So Sajid, I would love to see you anchor a few discussions to figure out and brainstorm as to what is the best way of doing this. Remember, we are talking about 85 odd lakh people. Administering a test for 85 lakh odd people is not going to be easy if you're going down that path. At the same time, I'm sure there are good ideas possible on how do we make the filtering a lot more objective and data-driven. For instance, I think picking a leaf from this particular report, maybe we require that only people who have certain exposures to the cash market through mutual funds or holding equities, etc., maybe that be a filter to allow people to come into derivative markets. You please get comfortable with cash markets first. You understand the basics of the cash market before you dip into derivatives. One of the reasons why we see so much of small retail participation in options, as you well know, for buying options, I don't need to place a margin. So I only need to put that 2,000, 3,000 rupees that I'm actually placing as the premium, right? And there's no margin required. Maybe one way of making sure that people who enter and buy options actually know what they're doing is making sure they have a holding of equities or some kind of cash in the background in lieu of a margin. I'm not asking for a margin, but demonstrate that you have some wealth before you start actually participating in this market. Now, I know all of these are going to be controversial, which is why it's important that a debate happen which involves all stakeholders. Remember, there are plenty of stakeholders, including exchanges, clearing corporations, brokers, intermediaries, advisors, traders themselves. I think it's important we have this debate, but we should recognize that, this current ecosystem is not necessarily in the best of shape. If so many small traders, 70% of the people making losses don't even have 1 lakh rupees in their demat or in their asset account, right? Which is not a great sign. I think that is something we have to debate.
When you spoke about debate, the biggest debate is on closing auction session, which is happening. Around 1,000 odd crores of turnover, which is happening on the NSE, and maybe 180 to 200 crores of turnover, which is happening on the BSE. How do we bring in liquidity into closing auction session? And it's now turning into like a pre-open session which doesn't have any liquidity, and it's just it's there for 15 minutes and then the trading starts at 9:15.
So Sajid, plenty of points here. First, I think it is important to reiterate and understand that globally this closing auction session is pretty much ubiquitous. It's there in all major jurisdictions. And one of the reasons, as the SEBI chairman also explained, that SEBI went down this path is that increasingly we have global passive funds who are investing in India, who are interested in India. And for them, we can't stand out as an outlier where we have a very different operation compared to the rest of the world. And therefore, the tracking error for them is different in India compared to other parts. So it's important that we keep that in mind. And I'm sure your viewers understand this as well. Now, on the point of liquidity, I think it's important to reiterate one thing. I think a lot of the concerns rightly come from those trading in options on expiry day, because you have a lot of expiry coming up, and then if you're settling on the basis of, let's say, 1,000, 1,500 crores in NSE or 200 crores in BSE, then you think there is a problem, and rightly so. But here is my underlying point. It's not as if in the earlier volume-weighted average situation, things were any dramatically different. Remember that the actual expiry used to happen on lakhs and lakhs of crores of open interest being settled on the basis of 8,000, 9,000 crores on NSE and 250 crores on BSE. So the problem that we had, that a very small amount of trading in the cash market was determining the fate of lakhs of crores of expiry.
Even then, 8,000 crores versus 1,000 crores.
I'm saying the ratio, without talking about, I agree 1,000 crores is small. But I'm saying your 8,000 crores also itself was much smaller.
Yeah, I agree.
And now, if you remember, not long ago, there would be allegations that on certain days, funny things are happening. Oh, today is a very quiet close. Nifty is closing suspiciously at 25,000 and it's not moving one way or the other. Something is happening, right? So the point about this confusion or suspicion about was there even in the earlier days. Now, the point that, again, the SEBI chairperson has rightly made, in the CAS ecosystem, the ability for exchanges and the SEBI to actually monitor that very, very closely to ensure that there is integrity around the setting is much higher than in a normal closing, in a normal continuous session. Things like spoofing, for instance, as has been demonstrated in the order which came out recently, that is, in a CAS, the entire session is under spotlights. It's under floodlights, and every single thing is being seen, right? So to that extent, I think the confidence that we should have that the actual operation of the CAS is much more stronger than the VWAP, purely because of the ability to surveil, I think should be higher. But I take your point on the need to increase liquidity. I'm sure that there are work happening with SEBI and market participants around this. I can think of two areas where I think we should do some extra work. Arbitrage funds. Normally mutual fund arbitrage funds are the right set of market participants to ensure that there is a semblance of stability in the market and that the prices don't move too much away from the fair value, right? They are natural, balance providers in the whole ecosystem. Now, the way in which they've been operating so far is clearly on a simultaneous operate in the derivative and in the cash market with no risk involved. Now, if they were to operate in the CAS ecosystem, there might be a small mismatch in terms of the timing, because you see something at 327 where the futures markets are. The 328 is when the CAS results come out. During that time, you might have to take some risk for a few minutes to ensure that you catch hold of an arbitrage. I think it's important that mutual funds, particularly the arbitrage funds, have a discussion with stakeholders, including with SEBI, on how this can be allowed, how their operating model can be changed so that they can become far more active participants in this CAS, because they are the normal ballast providers, really. The second thing which I think, again, SEBI is working on hard is SLBM. For long, Sajid, we've been discussing this, that we need a securities lending and borrowing mechanism. I'm glad CAS has come about, because I think this will give a fillip to SLBM. The problem with SLBM was not lenders. Mutual funds, for instance, are ready to lend their stocks. The problem was there were no borrowers, simply because you could always short through the futures market or the options market, and that too with a leverage. Why would you do the trouble of borrowing stock out here? But with CAS, you actually have a need for borrowing stock so that you can take advantage of any arbitrage that comes in during the time of CAS. I'm hoping, therefore, that SLBM also takes off, which will actually be great for propagating cash market volumes in our ecosystem. And that will be good for the entire ecosystem. So my long story is this. These are early days as yet. Already, I think things are stabilizing. I think the confidence around CAS will eventually stabilize and become stronger and make the ecosystem stronger. It will be a far more reliable kind of ecosystem. And yes, I agree with you that things have to happen to improve liquidity. And on that, I'm sure SEBI is working hard to correct that.
And thank you very much for joining us today. This is a topic which will be going on for some more time before we settle in. But thanks for joining us today in our studio.
My pleasure.
That was Ananth Narayan, former whole-time director of SEBI. Thank you for watching. We'll be back after a short break.